going to want to use some new technology to help you in your homework assignments, and to review some important lecture material, and to go over some more demonstration problems since we often don't have enough time in class to go over as many as we would like. The first one I'm going to do today is going to help you with that first homework assignment, which is problem 7-1 on page 384. We have an Excel template set up in the portal for you. So if you're done like me and you have downloaded all of the assignments, we can click on assignment 1 and it'll bring us to our Excel template. And in it, I have put the given information. Remember, this is a summary of the information. You need to read the full problem in the textbook. So let's do that. Let's take a look at this problem. We have a company that sells on credit, as GAAP requires. When you have material amounts of receivables, you need to use the allowance method. Now, in the allowance method, there are two general approaches that companies use. Both are generally accepted, and GAAP doesn't dictate which method or combination of methods a company has to use. So for this company, they're actually going to use a hybrid method. During the year, they're going to determine the bad debt expense, match that expense against the revenue for that period using an income statement approach method. That is, they're going to take the monthly sales and they're going to multiply it by 3%. So 3% of sales will be designated as having potential bad debt expense. Again, this is a judgment. How do they come up with this 3%? They look at past results, future projections related to the economy and the risk that they're taking by extending credit to their customers. So they're going to develop this 3%. Under the income method approach, you're going to be recognizing that bad debt expense through a debit to bad debt expense equal to the amount of sales and a corresponding credit to the valuation account or allowance account, allowance for uncollectible accounts. Bad debt expense, of course, is an income statement account, temporary. The allowance is a permanent account. The problem then goes on to tell us that at the end of the year, the accountants will prepare what's known as an aging report. And that looks at the accounts receivable collection in full and categorizes accounts based on whether they are current, a little bit past due, or significantly past due. And of course, if you look at the probabilities, accounts that are significantly past due have a greater chance of becoming uncollectible. So this is known as the balance sheet approach. And why is the company using both? Well, they're looking to make their best judgment. So during the year, they want to track the potential for bad debt expense. They want to produce interim financial statements. So they're going to be making these adjustments throughout the year. And then at the end of the year, the balance sheet approach is used to determine how reasonable their estimate has been. So GAAP, again, doesn't dictate which method you're going to use. So this company is going to try to use both. Right? The problem then presents information about the company and what's in their records. They tell us that at the end of 2010, which of course is the beginning of 2011, accounts receivable had a balance of $574,000, and the allowance account had a credit balance of $54,000. All right, so you may want to draw a little T account here to visualize what's going on. So in your T accounts, you're going to want to show the beginning balance for 2011. These credit sales are going to do something to the receivables. You have to ask yourself, will a credit sale increase or decrease the balance in receivables? Next, we have cash collections. Customers pay us. What will this do to the accounts receivable? And then the write-offs here are the actual accounts that we have identified, and we have reduced those individual account balances down by the amount of the write-off. So again, you have to ask yourself, is this write-off going to affect bad debt expense? And you're going to get the answer to that by listening in class, looking at the PowerPoint, or reading the chapter. So you'll have a good understanding of the account balance at the end of 2011 in the receivables from this information here. The other T accounts that you're going to want to set up is the T accounts for the allowance for uncollectible accounts and bad debt expense. Remember, bad debt expense is a temporary account. What is the beginning balance of all temporary accounts at the start of the year? And you have this allowance that has a credit balance of $54,000. That's at the end of 2010. So in your T account, what are you going to put down for the balance for the allowance account on January 1 of 2011? So the company goes through the year, they have sales. Remember, this company uses a hybrid method, so during the year, they have made entries into the allowance for doubtful accounts and the bad debt expense. Remember, these write-offs, what will they affect? What is the debit? What is the credit when you write off an actual company's account? Next, we have our aging report. It shows each category of account, 0 to 60 days, 61 to 90, etc., the amount that is in there, and the percentage that is uncollectible. So to get the total amount that should be allowed for the uncollectible accounts, you're going to take the total of each group and multiply it by the percentage. The total of those will be what the balance in the allowance for doubtful accounts should be using the balance sheet method. And remember, in this hybrid method, that is the balance we want the allowance account to be. So you may have to either adjust it up or adjust it down based on this analysis. And of course, that will have an effect on the bad debt expense. So let's take a quick look at the Excel spreadsheet, what it calls for. First, it asks you for that income statement approach. So you're going to make a summary entry that is going to recognize bad debt expense up and through the adjustment that's being made using the aging. And you're also going to make a summary entry for the write-offs of individual account balances. So you're going to complete these entries. The accounts are given. Don't just fill in the blanks. Think about what's going on with those accounts. Before you can do part 2, the entry, you have to complete the worksheet. The worksheet that backs up the entry consists of this aging report. So you'll take the amount in each of these accounts that's given, multiply it by the uncollectible percentage, and come up with the estimated allowance. then going to take the beginning balance for the uncollectible accounts from January 1 of 2011. You're going to add in the bad debt accruals that you calculated up in requirement number 1, and then you are going to adjust for the write-down for specific accounts that went bad. So that will be your balance in the allowance account prior to the application of the balance sheet approach, the aging report. You'll compare what you have with what you want to be, and that's going to be your increase or decrease in the account balance. For number 3, you're going to look at the bad debt expense that has been accrued throughout the year. You did that up in requirement number 1. You're going to look at the adjustment that you made in requirement 2 using the balance sheet approach, and that will give you the total bad debt for the end of the year. The bad debt at the end of the year does not have to equal the allowance for doubtful accounts. Finally, you're going to present the net amount of accounts receivable. You're going to determine that by applying the T accounts that we calculated before, the T account for accounts receivable. You're going to come up with the ending balance, which you have here as a given, and then you're going to subtract out an amount, and I'll leave that up to you to determine whether that amount is the bad debt expense or the allowance for doubtful accounts. So I hope this helps. Be happy to get any feedback on this approach. Hopefully my voice isn't too nasal. It usually is. So go and work on the problem.